Hello, everyone. Thank you for joining our webinar this evening. I'm Margot Kennedy, and this is Christy Brock, and we are wiicre. We
We
invest in
invest in
commercial
commercial real
real estate.
estate. Today, we're talking to you about Access La Grange. This is a 506c investment, which means it is for accredited investors. We're happy for everyone to listen and hear about this project, but the actual people that are eligible to invest are accredited investors. And we will jump right in.
So this is our disclaimer. Everybody has some fine print, but the important thing here is that we do follow SEC, not a solicitation to purchase securities. This is not an offering at this moment. Uh, that can only be done member that if you're interested. Really just a summary of general information about this specific.
Our mission is to empower our investors through self-storage investment. And I apologize, my internet is having a little bit of a problem. We're having some weather here, and so I'm having a little bit of an unstable connection in any case. So
Mm.
our mission is to empower our investors and provide excellent opportunities for self-storage investments and to educate and provide these types of partnerships because we really believe in this asset class because it is recession resistant and very scalable and stable and a great way to provide long-term financial freedom. Again, I'm Christy Brock. I've been in real estate for over 2 decades. I've raised a lot of money. Margot and I together, this will be our fifth project that we're purchasing for self-storage together. I'm past GP on two other projects and super happy. Margot and I have been together for 3 years, 4 years now, 4 years.
Going on 4, I think.
Going on
Yep.
4 years, yeah.
Yeah. Wow. Time flies. It really does. Yeah. So, I'm also a full-time investor at this point. I've got lots of years of experience in a lot of different areas. In the last 5 or so years, really transitioned into just investing in commercial real estate. And in addition to the self-storage properties that we're GPs on, I am GP on three multifamily properties, and I've got passive investing in a number of others.
Let's jump into Access La Grange. So this project is in La Grange, Texas, which is about 1 hour outside of Austin and an hour and a half outside of Houston. We're buying it for 6.9 million and we project an exit value just over 11 million in 5 years when we plan to exit. We're raising a total of $2.75 million. We are about 55% of that already raised, and we're very excited to offer our investors two classes for this. Class A, that's going to have an 8 pref and a target average annualized of 18%, minimum investment 50K, and a Class B, which is going to have a 10 pref and a 20% target. So Class B is estimating to double your money over a 5 year hold period. This facility is commonly known as A Prime Self Storage in La Grange, Texas. It sits just off of Highway 71. Great location. And we'll get into the story of it a little bit later, but it fits all of the normal things that we look for in a new acquisition. Why self-storage? We are going to really gloss through this,
We'll run through this quickly.
right?
It's a great asset class. We have sticky customers, which means that once people move in, they generally stay. So even though it's a month-to-month rental, they're willing to stay and accept a little small who's going to move over $5. Recession resistant will manage and operate than multifamily and other types of asset classes because we don't have tenants, we don't have toilets, and we don't have termites. And the returns are easy to improve. And as you probably know, the value of commercial real estate is based on the NOI. So we can manipulate it pretty easily in self-storage. improve it.
Right. And the market is growing. As Margot said, the customer base is sticky. The customer base is actually expanding at a tremendous rate in the just, 3, 4 years that we've been looking at this sector. It has grown by over 1%. And again, that's households. That doesn't
Household.
include businesses. And I would say about 10% at least, depending on the facility, 10, 15% of our customers are businesses.
Yeah.
And, we don't know exactly that number because some of those are rented as an individual's name and not in their business name because they are the gig economy, the people who
Mhm.
sell on Amazon and they're hustling out of their unit. So it's definitely a tremendous market and a tremendous opportunity.
So America needs self-storage. We like to say, whether or not we want the stuff or need the stuff, we keep our stuff. So, it is very driven by things that happen in everyday life. Stuff happens, divorce, death, downsizing, dislocation, disease, disaster. We all experience these things. And so frequently that causes us to need storage. And like Christy said, it's a huge percentage of households that are using storage in addition to businesses. And, also, we don't just store stuff. We can store boats and toys and RVs and things like that as well.
Right.
This is
Recession
my
resistant.
favorite
We
slide.
If you've seen us speak, you've seen us talk many times about this slide. The top line, the gold line, is the occupancies for self-storage. Even when the US economy is taking incredible, incredible dips, the occupancies for self-storage remain very high. And during our last dip, the occupancies were their highest ever. For some reason, and COVID really drove occupancies. They've come back down to a more normal level, and normal is, an average, industry average. What's normal for a facility or for an area is going to vary, but as Margot said, this is a fantastic graph because it really shows that storage is recession resistant. Okay, we're going to bypass this slide. You can go back and read it later, but these are the things that Margot was hitting on that it's very easy to control expenses and income. And we'll talk about those within the context of this investment shortly. Again, storage versus other assets, fast, great, high, compared to other other asset classes.
Yeah, and one of the things that's nice about storage is because it is month to month, we can adapt to changes in the economy and changes in what's going on around us very quickly.
Very
Whereas with, apartments, you've got a year's lease, office 3 to 5 to 10 years to 20 years.
right.
So it makes a big difference in being able to deal with things that come down the pike.
Absolutely. So storage, great asset class, a lot of opportunity. Let's jump into why this is a deal that we really like. Why this deal? So as I mentioned, this facility is called A Prime Self Storage, and it's in La Grange, Texas, on Highway 71. And so we're calling this Access La Grange. And La Grange is the county seat for Fayette County. It's a very lovely county. It has a strong population, extremely low unemployment, and we'll jump into some of those stats a little bit later in the presentation, but it's just a really great place. The facility is just over 48,000 net rentable square feet on 3 acres. And it actually has another almost acre of vacant land. Currently, there's about 336 climate, non-climate units, a retail space, and an office. There's 4 parking spaces currently not being utilized as parking spaces, but over the years they have been. It's a relatively new facility, built between the 1990s and 2020 is when the last building was constructed. Occupancy, physical occupancy at 79, but by square footage, which is the number that we like to look at, 82%. So it's a very solid, a newer facility, and it's in really good condition. And this is what it
So
looks like.
pretty.
Uh, you know,
It's our prettiest one so far.
It is. It truly is. And when you're on the ground, the storage is so boring. Look, it's metal, it's concrete drives. But for us, when we're there and you go, we're just looking at it in awe.
Yeah,
And we do have a few more pictures to show you towards the end of the presentation.
yeah,
But it really is a pretty facility. Oh,
yeah.
actually, no, I stuck them
There they
in
are.
here. Here
There
we
they
are.
are. Yeah.
We've got the sign. This facility looks just like something that is ideal for us. The driveways need to be power washed. They haven't been touched in a long time. Look at the multicolor doors. This is so easy for us. It's got a very good keypad. I've not seen a keypad that well protected
I know.
ever. It's the keypad is not going anywhere. No one's going to hit it.
Right.
Uh,
Right.
there's bollards. We bought one facility that had one bollard.
One bollard
Yes,
on, yeah,
this is so well
four buildings.
protected. There's bollards everywhere. There's just not a lot to do. This is really a managerial play. And this
Yeah.
is representative of the climate control.
Look
Clean,
how neat and clean.
yeah. I mean, it's just such a clean and nice facility. Um,
Unlike the others we've purchased, this one has been pretty well taken care of. And so,
yes,
like Christy said, it's really a management play. It's not a fixer-upper as much as the others we've purchased.
yeah. So we said that this is our typical profile for a deal, and it is. There's four owners. Most are in their late 70s. One gentleman is in his early 80s. They built this thing from scratch. They all own other businesses. One guy is an attorney. The property is not distressed. It's just ready for a couple of great people like us to come along and bring it into this century because it
Right.
is very much living in the 90s. Uh,
Yeah.
they have no solid website. You can't do online rentals. They don't take credit cards. Everyone gives their bank account and they do ACH, or they come in and they pay
Pay
cash,
with a
or they
check.
write a check,
Yeah.
which makes which allows for some of those allow for fraud, which we have seen on other facilities. So their
Yeah.
big challenge is as people who are in the later half of their life and doing a lot of succession planning, asset planning, you don't want to give your kids a problem. You want to give them a solution, something that's going to help them. And so those kids have no idea what self-storage is about. The owners are not 100% on what self-storage and how to really run a
At
facility.
least not today.
Not in today's
Yeah.
environment,
Yeah.
absolutely. So again, we've got amazing seller financing, and we'll get into that. But this is a really great facility, and it's right up our alley on so many different levels.
Yeah.
It's almost an even mix of climate and non-climate.
Yeah.
54% climate, 46%. I'm sorry, 54% non-climate, 46% climate. And the units are a good size. The average unit is over a 10 by 10. So it's really a nice mix. It's a nice facility. Um, Margot, why don't you talk about the
Yeah.
location
Look at
here?
that location. It's right on the triangle
Yeah,
between San Antonio, Austin, and Houston. And it's just becoming also, it's a growing, and more things are happening there. Christy mentioned earlier, it's a strong population. Population has been growing steadily, not leaps and bounds, but nice and steadily. The population is currently over and that's in that triangle.
right.
There are 30 right in that area, and that's a really large percentage of even what's in Texas, I believe. It's a great location right on Highway 71. I mean, you can't miss it. It's very visible, fast-growing economic region, and Texas is a really great state for businesses. There's no state income tax. They're very pro-business, and we like Texas for a lot of reasons.
Yeah. As I was researching, I was shocked that 32 of the 32 Fortune 500s are in this triangle. There's
Yeah,
54 in all of Texas. So
54. Yeah.
the others are in the DFW metro, but that means that this triangle has the bulk, and
Yeah.
that's amazing. So,
Yeah. We're right there.
yeah. And we always talk about we talk about location doesn't
Yeah.
matter. It doesn't. Location is not the most important for self-storage because self-storage is everywhere. But it is nice to see that the things that drive demand, which are life, things that happen in life, are happening here. And there's just a very solid demand for storage here.
Yeah.
So,
So, like we said, it is a great location. Here's some demographics. Household income for La Grange is over 80,000. That's great. Average home value is almost 400,000. That really, I don't know where that compares nationwide, but that's really excellent. That's way up there. Fayette County's unemployment rate is 3.5, which is better than Texas and the US overall. Like we said, it's on a major arterial with has great visibility and the signage is very visible. And as far as self-storage in the area goes, there are no facilities under construction, and we don't have any REIT competition either. The big buildings with the big boys who lure people in with low rates and then jack them up later. And that can be a little bit of a challenge, but there isn't anything here like that.
demand for this facility is strong for multiple reasons. One of the top reasons is this is one of the better facilities in the area. Aside from that, there's a major convention festival that happens every year called Round Top, and it attracts hundreds of thousands of visitors. There's just so much that's happening in this area and across the county itself, but particularly with La Grange being the county seat, they get
Yeah.
the bulk of visitors to this area. Everyone stops through. A lot of people live there. This facility has a lot of people who rent here have antiques and they store their antiques here. So it's just a really cool location and has historically been a very solid location. It fits our
So
buy box.
LaGrange,
Go
yeah, it
ahead.
fits our buy box. It's all the things we look for. It's a great story. These are sellers that have had the property and taken care of it, but they're ready to move on to the next phase of their lives. They don't want to continue doing this. But, it's great because we give them an opportunity to get out in a capital gains friendly manner, and they're going to have, uh, you know, um, seller financing so that they've got monthly payments, probably not quite as much as what they've been getting all along, but it's going to be close. And, they've they've not mismanaged exactly, but they haven't kept up with the times, as far as websites, as far as marketing and having rates that compete with what's around them. They have pretty much no online presence, and customer service is limited to the hours that they have someone there during the day, which, oh, by the way, is a great opportunity for us. Um, when we get to talking about, the things we can do to really improve the property, in addition to increasing occupancy, we're going to bring in tenant protection, which they don't have now, but that's increases income and it protects them in the event something happens at the property. And we also have in-unit motion detectors, which are really great. It will signal them on their phones if someone is in their unit, if someone is broken in. And that's just a real peace of mind thing for people. We will also implement online rentals and online payments, which, in today's world, most of us would prefer. And there is that little bit of expansion potential. And, one other thing, just sort of mentioned, we talk about increasing NOI. When I said it's got someone who's there and there's only customer service available when someone's working there. The way we manage, there doesn't need to be someone working there. We have customer service by phone for far more hours a day. And so we save day one a chunk of money on not having payroll and payroll expenses.
Right. The comps. So while we were there, we actually drove and looked at all of our
Mhm.
competitors, and this is everybody that's in the market. We will be the 500-pound gorilla when we take over this facility, especially from a marketing perspective. Only one of these other facilities has online rentals, and most of our competition, which is really interesting, they've got wait lists. They definitely, you have to call to see, if there's anything available, but nobody is doing online rentals and these facilities are full. So when you look at what current rates everyone is charging, the rates are low because the facilities are full. If you have a facility that's 100% full, what that tells me is that you
Your
should
rates are too
raise your
low.
rents a wee bit. And so that's what we will be doing, in addition to providing the additional services and is spending on CapEx to justify our increase. But definitely there's room here.
Yeah.
Our business plan is the same as every time we buy a facility. We're acquiring for 6.9. When you factor in closing costs, CapEx, etc., reserves, we're just about 7.8, geez, 7.5 million. We're just over 7.5, just under 7.6. And we have our CapEx plan. We've already started getting bids on the work, particularly painting, which is one of our biggies. And we have estimates on some of the other things. We plan a 5-year hold. And as I said before, we're planning to exit in about 5 years and expect our exit value to be just over $11 million. Margot, what are our keys to success?
So one of the big things right off the bat is we bring in third-party management, and they manage things in a totally different way than the property's been managed already, which is going to save us money, and it's going to be better managed um, because they're professionalizing the facility. And we're going to do the property improvements, physical improvements to the buildings, and they don't really need a lot. The driveways can use a little bit of work. We definitely need more cameras. I think what were there only 3 cameras or 4, something like that, not many.
I think there were 6 cameras,
Oh, okay.
but 4 of them are on the entry building.
Right. So as of the actual storage area, there isn't a whole lot
No.
of security. So, and we'll paint, like Christy said, and boy, does that make a difference right off the bat. It attracts attention.
Yes.
Everything looks clean and fresh. We'll improve the signage and the overall curb appeal, clean the driveways, and it's just going to look like a brand new shiny penny. And then, we manage to our business plan. We get the website going, we do all these things that bring up the quality of the operation and professionalize the facility.
Financial analysis. So, as we said, um, our total all in is 7,580,000. We have seller financing for 5 years. The first year is 4.5% interest only. And then the remaining 4 years are at 5.5% interest only. So during the projected term of this investment, we have no interest rate concerns. We are not worried about that at all. It helps with our planning. And what's really great is there is no prepayment penalty. If down the road, in year 3, someone says, "Hey, let me throw this money at you for this facility," we say, "Here's my
It meets
capture
our
SMIT.
numbers. Yep.
Yeah, here you go." And so that's really fantastic. So we are raising 2,750,000, and that breaks down to our down payment, our closing and startup costs. So our actual closing costs and startup costs include things like um, our upfront payments to insurance, our upfront payments to the property management company to get them started, and other startup costs like that. We have
Surveys and inspections.
surveys,
Yeah.
right? All, and those are all part of our closing and startup. And then we have CapEx, working capital, and reserves. We are going to have a somewhat of a large reserve for this because over the next 5 years, while the facility is in very good condition, we do have a couple of HVAC units that may go out, and that is 10,000 or more a pop every time that happens. We got a really great property um, report and a very detailed property inspection report. And this is one of the things, one of the few things that were called out. We also always hold reserves for the roofs because they are metal roofs and sometimes there's a leak. So that is something that we always hold reserves for. And of course, we have the normal things that happen, the seals on the doors that need to be replaced and little things like that. So
Yeah.
we do have we are doing a significant reserve. And then we have our acquisition fee, which on this project is at 2.7, a little bit below our normal 3%. And that's just the way it worked out when we were working our numbers.
Yeah.
So I know this slide is tiny, and so when you get your copy of this presentation, you can blow it up, or when you're rewatching it, you can pause and blow it up and look at the numbers. But what I do want to show you is that we have a much better version here. So right now on acquisition, they're bringing in, or their projected rents are just over 650,000. We've got a vacancy number, and then we have our gross. Their effective income is about 590,000. And over the next 5 years, we plan to take that up a little bit to 887,000. And we will do that through very reasonable rent increases. But the real thing is our ancillary income, providing tenant protection plans, providing the in-unit motion sensors, and other ancillary income like that. In addition, we will reduce the expenses. And so one of the important things, one of the important differences between self-storage and other asset classes, particularly multifamily, for management fee, for example, in multifamily, the management fee scales with your income because they charge a percentage
Percent.
of your gross, not even your net, a percentage of gross. Whereas with self-storage, it's a flat rate. So no matter what happens, no matter, if we're increasing our income, our net operating income is going from at acquisition just under 375,000 to 665, our actual management fee stays the same. That is fantastic.
Yeah.
Unlike what would happen in multifamily. And as Margot said, we are decreasing our expenses day one because there are expenses that the seller puts on that we do not.
Have.
We will not have a full-time employee in that same way. We also won't be running our own expenses through the deal,
Right.
which is something that a lot of owners do. So the bottom line is we plan to almost double our net operating income over the whole period. And again, here is our cash flow. The very bottom line is our actual cash flow that we're projecting. Our debt, the first year is at 4.5%, and then it's at 5.5% for the other years. So our actual income is going to be very significant and plenty of income for our investors and at the end of the day for us also.
Yep.
We're buying at a 5.43 cap rate, and our intention is through improvements and because of what's going on, we are projecting an exit at 6%. And what that means for us is, and this is our target valuations based on those exit cap rates. What this is just showing is that we can be off by our cap rate and our investors are still on solid ground.
Yeah.
Um, but this is just a cap rate sensitivity analysis.
Yeah.
Margot, why don't you show our
Sure.
cash flow?
So here are our return projections. This is probably everybody's favorite slide. If you come in as a Class A investor, and that's investing a minimum of $50,000, but under $100,000, You get a preferred payment of 8% each year and a target annualized return, average annualized return of 18%. So that would mean that in the first year, we'll start our distributions after the second quarter. So instead of being $4,000 a year like it is in years 2 through 5, you get 3,000 in the first year and then 4,000 each of the following years. In year 5, you would get that pref payment. You would get the return of your capital. And also in your pref payment, you would get the catch up from year 1. So you would get that $1,000 gets caught up. That's why it's 5,000. You get the return of your capital, you get your exit distribution. And so your total return on your investment is $45,000.
Right.
So that's a nice return. It's $20,000 throughout the deal and then the distribution on exit of 25,000.
Yes, an equity multiple of 1.9, which
Just
that's
about
a
two.
an average annualized of 18%.
Yep.
That's not bad, not bad.
Mm-mm.
And if you were coming in at the $100,000 level, Margot,
So that's a 10% pref and a target average annualized return of 20%. So you would get 10% pref each year. The first year, like I said, the first payment will be after the second full quarter of operations, and the catch up would be in year 5. So in year 5, after getting your $10,000 each year, and the catch up, you'll get a $100,000 return of capital, 50,000 at the exit distribution. And so that ends up being a 2x multiple and your 20% annualized return.
yep. If this is of interest or if you have more questions, then we have a soft commit that you can do, which is the tiny URL Access La Grange soft commit. If you are not a member of our fund already, please join our fund. There's no obligation to invest. It just provides you with our PPM, which is our overall investment theory. And
Mhm.
then we'll send you our deal disclosure. Our deal disclosure will be ready for this facility, for this investment, should be by the end of next week. But we are taking soft commits now. And as I said, we are at least 55% committed at this point.
Subscribe.
So we definitely suggest that if you have an interest, please act quickly.
Yep.
This is our contact information as always. And let me stop share so that we can answer
Yep.
some questions if there are any. Are there
Got
any
a couple.
questions?
We've got one. Do we plan to keep the same name or rebrand? We are going to keep the same name. There's no negative connotation with the
No.
facility, so no reason to change it. We probably will change the sign so it matches our color scheme, but we'll
And
keep the name.
that's absolutely in our budget to
Yeah,
put that to change
yeah,
that. And just to it just will look better. When you
yeah.
saw the pictures of the current signage, it's faded, it's unattractive,
Yeah.
and a
We always
pretty
like to
new
do the
sign.
signage.
Yeah,
Yeah,
pretty new sign to match our colors.
yeah.
Great.
And here's a great question. Do you think there will be potential for accelerated depreciation? You bet. We love
Absolutely.
accelerated depreciation.
Boy, do we. Yes.
Yes.
Yes. We will have some preliminary numbers. Our target is, always about 80 cents on the dollar over the whole period, 80 cents or so. So we'll have some estimates coming pretty soon, but hopefully that's where those numbers will shake out. So
Yeah.
yes, we will be doing the full study, and we're excited about it. This
Yeah,
this
absolutely.
project, I mean, it's definitely very interesting, Brian. So I knew someone was going to ask this. So here's the thing. While I let me go back and let me go back and
Yeah.
bring up a slide because this facility it has a little bit of a different thing happening. Um, let's see. And let me share power plant.
But, just sort of as some background, we have another facility, the one we have in Mead,
Hmm.
as you know, that does have a cellular cell tower, and that is not as lucrative as people think, generally speaking.
It's problematic.
And it is a problem. So, it's funny, and having gone through these things, there are some things that we're not real keen on doing. Um, you know, Sort of cell towers and truck rentals. We're not big on that
Yeah.
anymore, having done both.
Right. So this facility has this big rectangle of land. There
Mhm,
is a setback of about 30 feet. So there is maybe 3/4 of an acre. You could easily put another building of this size here on this land. And we have not factored any of that into this investment. And there's a very important reason why. If we know about how much it costs to build. If we want to
mhm.
build on that land, it's going to cost us probably 300,000, maybe 400,000. Um, it and that range is because there's also the concrete driveways that have to happen. So
Yeah.
easily, it's 300,000 or 400,000. We don't want to raise 300,000 or 400,000 and then have to pay on that while we're doing it. It's very fast to do that type of expansion. And what we will do in a year or 2 years, maybe even 3 years down the road, when we know there's the demand, but there's absolutely the demand for climate control. Occupancy, we gave our occupancy stats. Our occupancy for non-climate is 74%, 74 or 77%, my apologies. But our occupancy for climate control is almost 90%. So we know there's a strong demand for climate control. So we would want to build some more climate control units there, but we don't want to carry the 400,000 or so.
Mm.
So what our plan is in a year, 2 years, 3 years, whenever we feel that it's the right time,
If we decide to do it, yeah.
if we decide to do it, then to go to existing investors for this project and say, hey, we're raising another whatever that amount is. Um, you have first right of refusal to invest. We want to do that in a way so that it does not um, detract from our existing investors,
Investors,
but it's
right?
gonna it's gonna detract from our earnings. So, we have our earnings that, we're doing our distributions to our investors. And then as you saw, that number, it goes up quite a bit. So we're gonna uh, owe our investors this much, but there will be this much income. So the difference is what we can use for while we're in the building and lease up phase, paying new investors, and the increase in value definitely just bolsters this whole project. So we do want to do something. Now, in the meanwhile, we could easily do parking because
Hmm.
that's relatively cheap to do.
Hmm.
Um,
Yeah.
but the highest and best use is absolutely building more climate
Right.
control.
Yeah.
But we need to understand the demand before we do that. So, are there any other questions? Okay. Well, we will send out a copy of this presentation, and anyone who's watching live or is watching the replay, we thank you so much. And
Yeah.
please connect with us, schedule a Zoom, schedule a call. We're happy to answer individual questions. And as I mentioned, we do expect this to fill in a very reasonable time frame. So thank you
Yeah.
so much. We
Yeah.
appreciate
Thanks
your
for
joining
joining
us.
us.
Okay,
Take
bye.
care. Bye.